The financial advice for someone making $100,000 a year can actually cost someone making $600,000 a year, hundreds of thousands of dollars in lifetime taxes. In this video, I'm gonna break down the exact financial strategies for 3 income brackets where real wealth gets built: $100,000, $300,000, and $600,000 plus. And at the end, I'm going to give you one rule that works regardless of what income level you are at. Let's get into it. First up, someone making $100,000. At this stage, really what it is trying to maximize what you can do as far as your cash flow goes. So you want to make the dollar go as far as you can. When it comes to your 401k, obviously you can participate in that to up to $32,500 if you're over the age of 50. So that can be a huge amount of money, and it might not be all amount that you can save at this stage, right? Just to make sure you can pay for your life and enjoy it. If you're able to do more than that, some other things that you could start looking at is opening up a Roth IRA. And in a Roth IRA, you can do $8,600 being over 50. It's a fantastic way. We love Roths. You're able to put money in after tax, and it does grow tax-free. The other one is going to be on your health savings account, or your HSA. When it comes to HSA, it's a fantastic mechanism. Again, it's triple tax-free, meaning it goes in tax-free, grows tax-free, and comes out tax-free as long as it's used for medical expenses. So again, if you can max out your HSA, you can put away $8,750 per year into the HSA. So definitely something that you should be looking into when you look at your health benefits come due in open enrollment time. Now, let's talk about the 300K plus earners. In this category, obviously, there's a little bit more money to walk around with, a little more strategies that we can look at. One of the biggest ones is obviously on the 401k side. So when it comes to 401k, one of the big things that you might wanting to look at is going to be looking at doing a Roth in the 401k. The first step is going to be how much can you put away on an after-tax basis. If you can max out the full 401k, then the next step is going to look at a mega backdoor Roth. If you can do a mega backdoor Roth and your company allows it, now you're talking numbers of $70,000 that you can put away into a Roth. That is huge amounts of money that can grow tax-free. Obviously, you pay taxes on it this year, but that can be a huge advantage in the future in your retirement to have that kind of nest egg that won't be subject to taxes in your retirement. The other option is that you can do a donor advised fund. So this is really where it comes to if you're charitably inclined and you want to do what's called a bunching strategy. Now, obviously, the standardized deduction is quite large and most people aren't going to be able to get over that hump. But what you can do is if you're charitably inclined, you can bunch all of your donations in 1 year and you can, in essence, put money away into a donor advised fund that you can then gift out to your charity of choice over the next couple of years. So in essence, you put a ton of money into the donor advised fund 1 year, you wait maybe 3 to 5 years and you do it again. It can be very helpful because you can actually itemize, which puts you above the standardized deduction and helps you have a little bit of a tax break in that 1 year. And then the next year when you do the bunching strategy again. Another thing you can look at is obviously at this stage, you should be building up taxable accounts, which basically is just a brokerage account that is growing. And you also are going to have to pay capital gains tax as those gains grow within that account. One thing to think about is going to be tax loss harvesting. So really what that is just making sure that as those accounts grow, maybe you sell some of the gains and offset some of the things that might have not done so well. And so you have losses. And so you offset the gains with the losses, in essence, trying to keep the basis low while the portfolio keeps growing slowly and slowly. But again, you're not having to pay those taxes. It's just being tax minded, looking to make sure that you can grow in a tax efficient way. Next, let's talk about 600K plus earners, because at this level, the entire game changes and the strategies become genuinely exclusive. If you are making over $600,000, the first thing that you want to look at is going to be a cash balance plan. Now, these plans are normally available for people who own their own businesses or solo entrepreneurs, or it's something that maybe you're a partner with your company. Now, these plans can be extremely beneficial in regards to being able to put away a lot of money on a pre-tax basis. And when I say a lot of money, I'm talking about $150,000 to $300,000, depending on your age. And that's the money that you can put away without having to pay taxes on it in 1 single year. So these accounts can grow extremely fast when we're putting that kind of money away. Now, the second is going to be on the insurance side of things. But once you get into this kind of income bracket, obviously you're at the level where you have enough income and enough cash flow that you can already be maxing out your 401k, maxing out your Roth IRAs, maxing out all the other contributions that you might have available with the HSA or something like that. And now you're looking at other ways that you could put away money on a tax deferred basis or maybe even a tax benefit basis. And an insurance plan can definitely do that in regards to maybe doing a universal index life policy or something like that. When it comes to these obviously are quite complicated. You also have to commit to being able to put them out away a certain amount of money every single year for a couple of years. So again, this is when you're at that income level and you're going to expect to stay at that income level for some period of time. Now, the third thing that you can actually look at is really where we get into looking at private placement deals as far as investments, where we're looking at limited partnerships, whether it be in oil and gas, real estate. We also could start looking at other things in opportunity zones. Opportunity zones can definitely have a very tax advantage thing. They came out quite a few years ago. In essence, it's basically investing in real estate or businesses within a kind of geographical area that the government has decided has been, we'll say, needs some improvement. And so if you invest in those types of areas in that business or real estate, put in improvements into those areas, the gains that you have within that investment can actually grow tax-free as long as you hold it within 10 years. Whatever income bracket you are in right now, there's one rule that ties all of these strategies together. It's a rule that the wealthy use that almost no one's talking about. And what that is actually putting your money into really 3 different buckets and not relying on just one singular bucket to make sure that you get to retirement or you get through retirement. That's the mistake I see quite a few people make at almost any income level is they have all their money into a tax deferred account, right? So that's your 401k. So it's money that you put away, you got the tax deferral in that year, and it grows tax deferred, but when you take it out, you actually are going to have to pay taxes. And we can call that kind of the RMD trap, meaning the required minimum distribution trap. So once you reach that age, you are going to be mandated to take out a large sum of money based on your age and how much that account has grown to. So when I see accounts that hit, the $2, $3, $4 million range in regards to their IRAs or 401ks, it's going to be a large amount of money that's going to have to come out in that RMD. So not putting all of your eggs in that one singular tax deferred bucket is really where this comes into play. So obviously you want to have one bucket where you are getting definitely your company match, but again, not putting everything there, not just completely putting, that and I'm done. The second is going to be looking at a Roth, right? So a Roth is basically pay the taxes today and then it grows tax deferred. With a Roth, it can be a little bit of an interesting strategy because you're limited on the amounts you can put in any given year. So obviously it's a smaller amount than in the 401k side, unless you're doing a Roth 401k, something to consider as well. So again, you're wanting to have those 2 buckets on the retirement side, on the qualified accounts. And now the third bucket is the one that I see the most people kind of just forget or just not do at all. And that's going to be on your taxable side. And what I mean by taxable side is it's basically just a regular brokerage account or a regular account that grows taxable, meaning that the gains that you have within this account, you are going to pay when you sell any of those investments in that year. Now, these accounts can be extremely helpful, extremely useful in retirement when we're trying to figure out some tax strategies to make sure we stay in a lower tax bracket, right? So if we're trying to not take too much from an RMD, we're trying to do a Roth conversion, we're trying to kind of make a year where we can figure out how to pay for medical expenses, something like that can definitely be helpful that we can pull from that isn't going to be taxable, or we can offset it with maybe some losses we have. It's an extremely useful tool that a lot of people don't have, and I feel like people overmiss on any income level. And so you definitely want to make sure you're looking at having those 3 different types of accounts: tax deferred, tax free, and taxable in the current year. Let me bring this all together. If you're making $100,000 a year, the priority is maximizing the 401k, including the catch-up contributions, opening that Roth IRA, and the backdoor strategy if needed. If you're making $300,000 a year, the priority is going to be looking at a mega backdoor Roth, a donor advised fund, and looking at tax loss harvesting. And if you're making $600,000 or more, the priority is looking at a cash balance plan. And no matter what level you are in, the diversification rule is the one that ties it all together. All 3 buckets working in harmony. Here's the truth. Generic financial advice from the internet was never built for someone at your income level. Your income matters. Your goals matter. Your tax situation matters. The right plan is built around all of those things together. If you're ready to actually sit down with someone who will build you a real plan for your specific income and the life you want to live, click the link in the bio and book a call with me. It's completely free. It won't cost you anything. Whether you're at $100,000 or $600,000, I will help you put together a plan that actually fits your situation. I'm genuinely excited to see you there.